Assalamu alaikum warahmatullah. My name is Safir Bhatti. I am the program director of the National Senator Tijara Department in the Department of Mentorship. My co-host this evening is Atiq Ahmed.
Assalamu alaikum.
Wassalam tullah, Atiq Sahab. Together we are creating a program called The Credit System in America. And today we have a very special guest all the way from England. His name is Ansar Khan. And Ansar Khan started his career in the mortgage department, in 1998 when he began his role in regulations. And in 2014, Ansar Saab moved his practice from England to the United States. Currently, he resides in outside Philadelphia with his family, and he is a mortgage banker for Allied Mortgage. Ansar Saab, Assalamu alaikum. Jazakallah for joining us today.
Assalamu alaikum. Thank you for taking me on, actually considering me for do this seminar with you. Jazakallah.
Jazakallah, Ansar Saab, and thank you so much for joining us. So let's get started. So, if we're in the market for a home, and I know these days with COVID, the rates are very low, and they're coming down to 1.8, 1.9%, and people are talking about buying a house, and this thing always comes up. Our credit score. What does that mean? What does our credit score actually truly mean, and why is it such an important factor before even looking at a house?
Safir sir, my favorite example that I actually give it to all my clients when they actually talk to me about the credit scoring. I say to them that this credit scoring did not start back in 20, 30, 40 years ago. It actually, as a Muslims, we believe it started 1500 years ago when our beloved Prophet Sallallahu Alaihi Wasallam was being called Sadiq and Amin. This simply scoring, which means is that if you lend someone, to make it very simple, $100, and you make a contract with him to say that, look, you pay me $10 a month, and if you live up to your obligations and you start making those payments regularly, the person will actually then extend further credit to you. So credit scoring is more like whether you are able to lend money and be comfortable that your money is going to be returned back to you in whatever return that you have agreed with them. FICO basically is a corporation which is called Fair Isaac Corporation. It actually is used by almost about 90% of the lenders to determine credit availability to people.
I see. So how does and who does determines this number? I mean, what does it mean that you have a 500 credit score or 800 credit score, or 850 or a 700 credit score? What does that mean? How are these scores actually calculated, and how do they move up or move down every month?
The low score that you can have in determining credit is 300, which is classified as very poor, and it could go up to 850, which is excellent. Around 40% of the total US population has got around 740, 730 credit score. How it is determined is that if you borrow money from a bank and you return that money with the contract that you actually made with them, it's actually called on time, they will gradually, your credit score will start building up. So there is something called also a credit mix, which means that you have got a credit card, you got an auto loan, you got a mortgage, and all these three factors combined together will help your credit score will actually start going up. In today's world, any utility that you go to, they will actually always run a credit on you to see whether you are a credit worthy customer for them. So you having a good credit can save you thousands effectively for your credit for your getting credit from your utilities. And basically the idea is that if you borrow money, borrowing money is not a crime. It's actually because the whole economy works around money borrowed from the financial institutions. But the more important thing is whether you are able to return that money according to the contract that you have signed with the lender or the person who has extended the credit. In mortgage terms, when you actually say you sign a document called, which is a promissory note. Promissory note effectively is that you are making a promise to that lender that you will return that money according to the terms that you have agreed, and that these all factors will help increase your credit.
Okay, so let's say you're out, shopping, and you have a. So how is your balance on your credit card determined?
Okay. The FICO comprises of four or five things. One is the credit utilization and the payment history. These are the two major factors, which is if you make payments on time, this actually equates to 35% of your total FICO score. So lender knows that they're determining the risk that you are making the payments on time. 30% is a utilization. So let's say that if you got a credit card, you've got $1,000 limit, and if you have maxed it out to 99%, that will actually bring your credit down. So if you have got credit 1,000 and you return that money on time, or your utilization is maybe less than 70, 50, 30, and 10, that will also build your credit also. It will give you more points.
So if you are maxed out on a credit card, let's say you have $1,000 credit limit and you're at 99%, and you make your payments on time, but you're maxed out, does it actually help your credit score go up, or does it actually decrease your credit score?
It helps also because you are actually living up to your contractual obligations. But because you are actually maxed out, that actually is not good for you, because that equates to 30% of your total FICO score. So it's always good to actually keep your balance as minimum as possible. And you talking about credit cards, you need to understand the history of credit cards also, how they actually originated. These credit cards originated by the American professors back in 1950s. Effectively, if you consider that you actually got paid on the first, and for the 30 days you were actually diminishing or whatever money you have, and come the third week, you haven't actually got any money, and that's when the credit cards were actually brought in as a cash flow thing. So you actually spent that money, 30 days you spent it, and then you returned it back within that contractual period. But as the evolution took place, the expectations went up, and people got used to it to actually say, okay, fine, we'll actually pay a minimum balance, without even realizing that actually by making minimum payments, you are actually incurring huge amounts of interest that you are actually paying. And credit cards.
So making minimum payments is not a good thing while keeping a credit card.
Absolutely not, because actually, generally speaking, any credit card that you will see that they are actually charging you 15, maybe 20, 25, maybe up to 30% APRs. So every $100 that you have borrowed, over time, you can actually make a minimum payment of $5, let's say. But actually, again, now you are actually making interest payments on that $95. So that is the most expensive thing that you can ever consider doing it. It's not a bad idea to have a credit card. You spend it, you actually normally given about 30 to maybe 59 days to pay that off. It's more like actually helping people with cash flow, nothing more than that. But because people's expectations and their desires have actually changed over time, so they want to actually, we moved away from the point whereby we need everything now. Then actually we can save that and actually maybe buy after 4 months. Sorry, I digressed on that. Sorry.
No, that's very good. So basically, you're saying that if you have if you use a credit card, you should pay the entire balance every month. You should not have a balance on your card, right?
Ideally speaking, yes. But if you can't, then at least pay that you are not maxing your credit card out.
What is the most balance that you should keep? What's the percentage you should keep on a credit card?
Ideally speaking, you actually spend and actually pay back immediately within 30 days or whatever period that you have. Otherwise, there's got 4 tiers. One is that you actually have 90%, 70%, no, sorry, 70%, 50%, 30%, and 10%. So every time that you go above 70% utilization, your score drops. So if you actually bring it down to 70 and then 50 and 30, so every time you bring it less than that, your credit score will go up.
I see. So your credit score will decrease the less credit utilization you have.
Yes.
Yeah, exactly. And the more, and even if you are making on time, 100% on time payments, but they're minimum payments, they're actually hurting you both short term and in the long run. Even though you're on time with your payments, because of the interest that's occurring, and that your credit utilization is going above the 70% mark because you're already close to max out,
Yeah.
right?
It helps in a way because you are actually making your contractual payments. So that's actually a huge, massive positive because it's actually your whole score is made of 35% is actually made of regular payments. But on the other hand, your utilization is increased. So that also that will actually hurt you. But if you can actually bring it and actually down to maybe 70, 50, or 10, or 30, or 10, so you will actually now imagine out of 100, 65% is actually made up of utilization and payment history.
Okay, I see. So when it comes shopping for a home, now that you know that how much credit utilization you have, how many credit cards do you have, how do you know how much house you can actually buy? Is that also determined on your credit as well, or how do you determine that if you can afford a $300,000 home or a $500,000 home? What factors are determined there?
There are multiple factors. Credit plays a huge role. But in today's world, we have got government-sponsored FHA loan, which effectively government guarantees. And you can start off with a key as low as 585 as a credit score. But with a conventional, you need to have a higher credit score of beginning from a 600 and 620. But then, insofar the affordability is concerned, obviously it depends on your complete DTI, which is DTI is debt to income ratio, which is made up of your mortgage payments, how much you're going to be making the payments, your property taxes, how much you're going to be paying tax. In certain parts of the world, like in New Jersey, the taxes are quite big. They're huge. And then hazard insurance or homeowners association also. Then you got mortgage insurance as well. That will also be part of DTI. And if you are buying a condo, there's actually homeowners association fees as well. So all these factors, and plus any other debt that you have outstanding, credit card debt, maybe auto loans or anything. These are all factors will determine how much you can actually borrow.
So when you talk about credit card debt or auto loans, how much can you have out when you're looking for a home? Can you give an example?
As such, you don't have to. You can actually have three loans on an auto car, or maybe you can actually have three different cards, whatever that may well be. But also, it actually also determines on the property taxes how much property taxes you're paying, or what product you are actually going on. An FHA maybe actually depending how big a house or actually how expensive house you are actually buying, obviously then, and how low your credit score is, because if your credit score is low, you will actually pay a higher amount of mortgage premium, mortgage insurance. So that will also affect you negatively. So in a way, it's actually very difficult for me to actually give you an answer whether you can actually have a one auto loan or two auto loans or actually no auto loan as opposed to three credit cards. So these are the factors which are actually determine how much you can borrow.
When you talk about an FHA loan, what do you mean by that? And what what is the biggest difference between someone other than the score you mentioned? What are the incentives of going to FHA? Is there a different down payment? Is there does the loan look different over time? Can you explain that?
Yes. FHA is given to people, generally speaking, there are many factors. One is that if your credit is low, then you generally go for an FHA loan. Secondly, is that you can only have to put down 3.5% as a down payment. Thirdly, is actually if you have actually been made bankrupt, so you actually don't have to actually wait until that you actually been as a discharge bankrupt. So if you've been making your payments on a regular basis for the last 12 months, you are allowed to buy a house as long as the court actually gives you the permission to buy the house. But as opposed to conventional, you have to be discharged for at least about 2 to maybe 4 years.
I see.
Yeah.
I see. Now,
And
you're talking about 3.5% down payment. That is based upon the asking price for the home, right?
yes, that's actually the purchase price of the property. So in simple words, if you're buying a property for 100,000, so it'll be 3.5% will be as your down payment. But the mortgage insurance you have to take out, and mortgage insurance normally stays on the FHA loan for 11 years. The other difference is that with conventional, as soon as loan to value comes down to about 78%, 79%, you can have the mortgage insurance removed. But in case of FHA, it will actually stay there for 11 years unless you refinance the property.
And when you talk about mortgage insurance, what does that mean?
Mortgage insurance, in a way, simply it's actually giving guarantee to the lender that in case of the property being foreclosed, they will actually get their money back.
So it's protecting the mortgage,
Yes,
right?
for
So
protecting
on
the
top
lender.
of, I see. So you, let's say for $100,000 home, you put 3.5% down. That the money has to go to the bank, right? And then on top of that, whatever the amount that you pay a month, you have to pay an extra $200 a month for the mortgage insurance.
Yeah, mortgage insurance is it's an insurance you take it out. Okay. And that insurance you pay for it and you protect the lender in case that you if you were to actually default on your payments and subsequently were to go into foreclosure, the lender will at least get their money back.
I see. And then you pay that for 11 years straight
11
until
years.
11 years straight. And then until that point, then they can determine if you need to have the mortgage insurance or not. Now,
Because
go ahead.
let me just correct that. Because after 11 years, basically because the mortgage payment is made of two components. One is interest and one is capital. So in 11 years, you would have actually paid some kind of capital, and that capital should be enough for the property, and plus the property would have actually gone up in value anyway. So effectively, your loan to value has fallen below 80%. So once it actually hits 80% or 79%, then you don't need to actually have an insurance. But generally speaking, I would say a lot of people do not stay on an FHA loan for 11 years unless they actually keep refinancing for cash out, they're getting more and more money out of it.
I see. I see. Now, when you're creating you're looking at a house before, um, you know, how do you like? Of course, your credit score is there. You know you have a pretty good credit score, and you want to actually get a house. Um, some people say I've heard that you need to get pre-approved first. What are your thoughts about that? Do you is the pre-approval, does pre-approval hurt your credit, or and how does a pre-approved mortgage application look like? Does it tell you how much house you can buy? Can you explain that system a bit?
Yes, excellent question. Pre-approval, no real estate agent will actually take you to see a house, because they need to remember one thing, that actually the real estate agents, you go to an agent and probably he will end up showing you 30 houses. Now, he's not going to be able to waste his time because he's not being paid a cent right now. So real estate agents will insist that you have a pre-approval how much you can buy the house for. So you can actually go to anyone and actually say, I want to actually buy a house for $1 million. Good, agent will be happy. But actually, can you quantify whether you are able to actually, are you pre-approved to buy that property or not? So they will, it's a good practice to have an pre-approval, because the lender will give you a commitment that this is how much you can afford to buy a house.
I see. So it tells you how much you can afford to buy a house, but in a pre-approval, you have to go through all the mortgage paperwork as if you're getting a mortgage, or when should you be ready to come for a pre-approval? What should you have in hand?
What I would actually suggest, that one, you need to actually have a budget in mind. So you want to actually buy a house for 300,000, let's say. Okay. Then you actually approach a lender, and the lender will insist on asking for your income verification, your W-2s. If you're employed, then W-2s, your pay stubs, your bank statements. And then after looking at it, they will actually give you a pre-approval to say, yes, Mr. Client, you are able to buy a house for 300,000 if you put down 5% down or 3.5% down.
I see. So it only asks you for income verification at the time of pre-approval, right? And it doesn't run your credit.
No. Credit has to be run. Exactly. Okay. You have to run the credit, because one of the things that why you actually, there are a few things why you don't want to actually run the credit. First, you need to actually find out what is the credit score. From there, you can determine whether you can actually take them to an FHA loan or a conventional loan. Secondly, is that whether you got a good credit or not. Some people may not actually have a credit. If you have got someone who's actually got 500 credit score or 400 credit score, you cannot be qualified for that loan. But once you run it, then you need to actually have all the paperwork. In case of employed, then W-2s and pay stubs. And in case of self-employed, you need to see their personal and business bank return, tax returns.
I see. And do you need to have your down payment ready at pre-approval as well?
Not necessarily. Maybe actually the down payment is coming as a grant, maybe from the local authority, maybe, or maybe your parents are actually gifting that. And it could be that you don't actually have to have that down payment in your bank account. So you can tell the lender, yes, I'm buying with that $10,000 is actually coming as a gift from my parents, my sister, my brother, or whoever.
I see. But they also look at your bank statements too, and how far back do they look at your spending habits to determine that you have enough money to pay for the mortgage?
Generally speaking, only 2 months, and they are not looking to determine that whether bank statement, the purpose of the bank statement is to actually twofold. One is to see whether you got any assets. When I say assets, whether you got any money, down payment money or closing cost money in that bank account or not. Secondly, if you are actually being paid, and whether your salary or is coming into that bank account or not. So these.
I see. So you talk about closing costs. What is that? Do FHA loan cover closing costs? Do conventional do not? How are closing costs determined?
Closing costs are made of multiple things. One is every lender will charge you an origination fee or a underwriting fee, whatever that may well be. So let's say $1,000 for that. Then if you're buying in Philadelphia, let's say, so there is a transfer taxes also, which needs to be paid. Then there are title costs that you have to actually pay. Then there are escrows also that you need to create. And escrows are, generally speaking, 6 months of your property taxes and 6 months of your insurance, hazard insurance or homeowners association, homeowners insurance. That will actually 6 months, the lender will actually keep that as a buffer, and it is given back to you if, when, as and when you change from one lender to the other.
I see. I see. So, and in an FHA loan, you have closing costs still, just like a conventional loan.
Every loan will have closing costs.
I see, and it all depends on the bank and how much you need. So, is there a percentage and overall, like how do you, like if you're buying a home that's $300,000, you have your down payment ready. How do you know how much closing costs it's going to happen?
It's difficult to determine in a way because we don't know what the taxes of that property are. So you could actually be buying a property for 200,000, let's say in New Jersey, where the taxes are expensive. Let's say there are actually 8,000 taxes for that property. So if
And
you
you have to
want
pay all 8,000 in that 1 month at closing.
no. That's actually a yearly, but you are actually you are creating an escrow for 6 months. So in this case, 4,000 will actually be kept in the escrow.
I see. I see. So, and that money in the escrow, that's used to pay your taxes, basically. So you
Yes,
go to
it's
your escrow and then withdraw the money, or the who takes that money? Is it the county takes the money for you, or you send the money to the county?
uh, the lender will send the money, but then this actually for the escrow which is created, the lender will keep that money, and that the money will be dispersed to the local authorities as and when the taxes or insurance is due.
Oh, I see. So the homeowner's insurance, like, is separate from the mortgage insurance.
Yes, because
I,
you actually, when you buying a property, you need to actually have homeowners insurance. Imagine a situation whereby the whole house was burnt down to ground. Now you could actually, as a client or as a owner, you could actually just literally walk away from that. But the lender who lent you 200,000, they are actually out of pocket then. So they need to actually, for your protection, for the lender's protection, you need to have a homeowner's insurance for this purpose.
and how is homeowners insurance calculated, and how do you go about that?
It's actually, again, one of the factors will be where the property is located, how big the property is, how much actually once the appraisal takes place, what is the reinstatement value of that property. When I say reinstatement value, you have actually got the land, and then obviously then you need to build the house. So
I
how
see.
much it's going to cost. So appraisal will go into the property and determine what will be the reinstatement value of that property is going to be.
I see. I see. And the mortgage insurance is provided by the mortgage company, right? You don't go to a different lender for that, correct?
No. Mortgage company will actually give you the mortgage insurance, and you will buy, and you will, with mortgage insurance, you don't actually pay that upfront. Some people will, you may actually want to actually pay it upfront in certain programs, but generally speaking, you pay it every month.
Every month, that's attached to your monthly loan, and then
Yes.
your homeowner's insurance, for the year, you put that money's also in escrow for a year's worth.
No, it's actually you still pay every month your homeowner's insurance. Let's say, make it very simple. 1,200 is the whole year's homeowner's insurance. So you pay 100 every month. Your taxes are 300. You pay that 300. But that 6 months escrow which has been created, that's, remember, this is a buffer. Okay, is because you are actually topping it up with that. Because if you're, imagine it's actually a situation whereby certain counties will actually, certain states will actually charge you taxes twice a year. So you building that. So you don't want to actually have a nasty surprise that you actually having to pay $10,000 at the end of the year.
I see. I see. So you, along with your mortgage payment, you pay a month. You pay your homeowner's insurance, and you pay your mortgage insurance, right, every month, and then you have the money in escrow there, sitting there just in case, if they need to pull the money from escrow to pay for your for the mortgage insurance and for the property taxes, right?
Yes.
Okay, so it's so meaning that if you pay everything every on time, you could technically pay your property taxes on your own, and not ever touch your escrow.
Yeah. So it's no,
Now,
no,
is
no.
the escrow money ever come back to you or no?
Yeah. Well, let's say that after when you are looking to refinance the house and you want to refinance to go to a different lender. Today, the rates are actually so low that people are refinancing it. So your existing lender will actually return the money to you within 15 days of your closing.
I see, I see.
And
So
one
only
thing
at
other,
the time of refinance, but let's say if you don't refinance and you're with this lender for 30 years, that money will remain escrow until that point.
yes, and they will return once you actually paid the whole debt, they will return you the money.
Now, I've heard from some people that people don't put the money in escrow because they want to use it for their own. How does that work? Or do you have to put money in escrow?
There are certain programs and there are certain lenders, and it all depends on loan to value. Is actually some people will opt out from creating an escrow and they want to say we want to actually pay our own taxes and insurance. In this situation, sometimes the rates are increased by quarter or 1%.
I see. I see. So on top of the down payment you have to look at the property taxes of the area that you're buying from, and factor in 4 to 6 months of this escrow and move that money on top of that. Okay. So roughly, as a rule of thumb, should you have if you're thinking to have a down payment of 3.5%, let's say 100,000 loan, should your actual down payment be 7% for the extra money that you need to use and put in different places like escrow or mortgage insurance, et cetera, et cetera, et cetera.
Absolutely right. I think that key, like in a recent case that I actually closed last week, it's they were putting down 10,000 down on a 200,000 property, and their total closing cost, the down payment came to about 21,000 or something.
21,000 for closing costs.
No, everything, the
Everything
closing cost and
down.
the down payment. So you're right, it actually worked out around 10% of that, maybe 7 to 10%, depending on the property.
Right. That's how much you should have because of the extra added fees that you have to go ahead and pay
Yes.
and do all different things.
And one more thing also, which is actually always good to have, if your total costs are going to be, let's say, about 20,000, it's always a good idea to have an extra $3,000 to $4,000 put in reserves, because the lender will always look at it whether you got 2 or 3 months of reserve with you or not. That's not part of any closing cost, but that is actually is lender will see if God forbid you are not able to, you lose your job or something else happens, whether you got any reserves, you are able to actually pay that mortgage for the next 2 or 3 months or not. But you
I
can pull
see.
that money immediately after closing. The lender will not insist that you have to have that money present in your bank account forever.
I see. So it also builds confidence with the lender as well. So, you're expecting to put 3.5%. You're at 7 to 10% right now, covering the cost, and then you have an extra $4,000 just to keep it, just to say, hey, look, if everything goes south for me, I still have some money to cover the mortgage for the next few months.
Exactly. And then some lenders will not qualify you if you haven't actually got that money. Not that lender is actually saying that you need to have that money in that account forever. You can pull that money out as soon as the closing takes place.
I see. Now, what happens if in the time that let's say you lose your job, right? Does the mortgage insurance become build unemployment insurance as well in it, or what happens at that point?
No, this mortgage insurance is nothing to do with you whether you lose your job or not. This is actually just purely protection if you were to go into foreclosure and you were not able to actually, if you were to go into foreclosure and the lender was to repossess the property or foreclose on the property, they will actually then have the confidence that at least they will recover their money.
I see. I see. So,
right?
well, what happens if you, are there any protections for you if you lose your job with the mortgage, or no? Or do they just accelerate the mortgage at that
There are
point?
no protections with the mortgage, but it's always actually is a good idea to actually have a separate insurance to protect you against that. Like for instance, when we were actually still in London, you it's actually always good to actually have a life policy in case of if you were to actually unfortunately you were to actually pass away, then at least your mortgage is actually paid. It's always a good practice to have a life policy. It's always good to have a protection of taking out an insurance to protection against if you were to lose your job for, and by the time you actually found a job maybe 2 3 4 or 5 months down the line, you have got either you have assets to cover that period, or at least that actually another company is actually making all the commitments for you, fulfilling your commitments.
I see. And is it true that the interest rate that you get on the mortgage, or the interest rate that you get on when you get an auto loan, or anything that you apply for, it is determined by your credit score? The higher your credit score you have, the less interest rate you pay. Is that, and the less per month that you pay as well, meaning that you pay more per month, you know, for something because your credit score is low or high?
Absolutely, absolutely correct. The higher your interest, higher your FICO score is, the better chance that you have of getting excellent rate, as opposed to if you have a low credit score, then you will actually get a higher rate, because you have to remember, everyone is actually factoring in the risk. If you have got a low score, the likelihood is that you have not been able to conduct your affairs in a good manner. So the lender will determine that, and they will say, okay, fine, if we are taking the risk, instead of actually charging them 3%, we are going to charge them 6%. So in case that we default, then we can recover our money.
So
Now,
basically, you're paying because of you couldn't handle your financial affairs properly. You're actually penalizing yourself by paying more for a house, or for a car, or for anything that you apply for with a credit score, because of your low credit score. And in essence, your payment per month is higher. Like, let's say, for example, if you have a low credit score and you're applying for a regular to do car, you may be paying more per month for that car, while someone with great credit score may be paying less and have a lesser interest rate. Correct?
absolutely, because actually it's always good idea to protect your credit score, keep it up, and remember one thing: it's if you make payments on a regular basis and you fulfill your obligations, then people would actually love to lend you. Why? Because where the lender, and the other thing is, your rates will actually, for everyone, the rates will actually come down as well, because lenders are factoring in the fact that if you were to default, someone has to actually pay for that. And when someone has to pay, these are actually people like you or everyone else or me. Everyone will actually have to actually pay that extra money in terms of actually the interest rate that we are actually getting. So if there are less defaults there are, the higher likelihood is that we are actually going to be getting a better rate.
I see, I see. And a better rate for you is better financial freedom as well too, and a better payment, and a better plan for you overall. So it'll be better for you to do it. Now, what happens if let's say again you lose your job and you're not working and you can't make your payments anymore? You can't make your minimum payments. Is it wise to not make payments on a card, or and how long can you not make payments for? And what happens at that point?
In that case, if you were to lose a job, it's always good to contact your lender and say to them that, look, I have lost my job and my payment is $100. Can I actually, for the next 2 3 or maybe 4 months, can I actually make a payment of, go into a contract with them, maybe 10 15 or $20, whatever you can afford, And the likelihood is that they may or may not report that because you have already agreed with them that you are not going to be able to pay the full payments. But as opposed to actually shoving it under the carpet and actually not doing anything, and actually the lender then uh, writing you a letter or actually subsequent letters, and then every time that they call you and write a letter, they will actually charge you 20, 30, or $40 for the default. And that all actually adds up as well. So it's always much, much good practice to actually confront this, talk to your lender and actually say, unfortunately, this has actually happened. I'm not going to be able to actually pay my contractual obligations, but can I agree with you to maybe actually start making these payments so you do not report it? And as soon as I have found a job, my circumstances actually get better, I will actually go back to paying the normal contractual payments.
I see. And how long can you go without making a payment on a card? You said before 59 days before it gets reported?
It's 30 days.
30 days.
Is 30 days. But if you were to confront this situation in advance and actually talk to your lender, if you have lost a job, they will actually agree, because you see, it's actually in the interest of the lender also, that is actually you have got someone who is actually coming directly to you and saying, look, this is actually the situation, let me actually give me some time, as opposed to they then actually not having any communication with him or her. And then you are actually getting debt collectors involved, third party people getting involved, and actually they're writing to you, they're ringing you and all that. And also there's one more factor over here, because actually if you were to actually be in that situation, the whole household is disturbed. So imagine, in today's world, how many people have got a home phone number. So if you're actually opening your post or you're answering your phone, and actually the third party debtors are actually calling you, it's not a good situation to be in.
And when you talk about debt collector, what do you mean by that?
Debt
And
collector.
and you're talking about these calls. Are they legally allowed to make you calls at any time they want, or how does that work?
Because when you have filled in your application, you have given them the consent and you've given them the telephone numbers that you can actually be contacted at this number. Okay. Few calls will actually be for marketing purposes, but the other calls is actually if you have not paid your lender, they will actually wait for 5, 6, or 10 days, and actually they will actually be reminding you to actually, at this point, you remember, they do not know whether you actually lost your job or not. They are actually thinking maybe you actually, for whatever reason, you have missed a payment. So they want to actually remind you to make that payment. And if you still haven't heard, they will actually be calling you and actually writing letters to you. And
I see.
if they fail to get any response from you, they will actually then get third-party sources in debt collectors. They will actually pass this on to the debt collectors, and then the debt collectors will be there to be to get the money from you. They will be actually be doing exactly what the lender needs to actually do, but because the lender hasn't got the full resources, they will actually pass on this debt to the debt collector for
I
collection.
see. Now, let's say you're in preparing to get a house and you want to get a mortgage, and you're getting all these offers in the mail. Okay, you have 10,000 in debt, you have 20,000 in debt, you have 30,000 in debt. Join us. We're a debt relief company. We'll do this, do that for you. Are those offers that you get in the mail fake? Are they real? Should you join a debt relief company? How do these debt relief companies work? Do they actually assist you, help you?
Very interesting question. And it actually so happens is that you have to remember these people are trying to make money from you. One thing that I've learned in my life is that lenders will never make people money from lenders will never make money from rich people. They will always make money from the poor. Okay, because that's why the pre-approved letters that you actually get, because if you're maxed out, they will actually say, okay, fine, let's actually send him another pre-approval letter. He will actually get another credit card and will actually max it out in a few months. Now, when you're talking about here debt relief companies. There are a couple of types of debt relief companies. One is that they will actually say, fine, we will actually negotiate with your lender. I know that you have fallen into problems, you lost your jobs. Let us do that. If you had actually tackled it head on, as I was actually saying to you, you don't need to actually come get in touch with these people. They will be exactly doing what you need to be doing with your lender. Pick up the phone, talk to them, and I say, this is the situation. But the third party relief companies will actually do exactly what you are going to be doing, but they will be charging you money for that. So they will actually say, they will actually agree a settlement with your lender. Let's say if you owe someone 100, they will actually say, okay, fine, our client can actually pay you $1 a month or something, knowing full well that actually paying $1 a month and to pay off that $100 will actually take years and years. And the lender will actually, there's no point for the lender to be actually keeping that debt on their balance sheet. The second type of people are that relief companies. They will actually say, okay, fine, we will talk to your lender and you come into a settlement agreement with us. Let's say that there's a 10,000 outstanding debt. So they will say, fine, we will negotiate with the lender, and they will, let's say, agree a terms of $3,000 a month or a year. And you will actually now be liaising with the third party relief company, and they will make money out of you. And they will actually, but in that, they will completely destroy your credit. For 7 years, your credit is gone. See, as I said, it's always good idea.
So is getting a settlement a wise thing if the debt relief company does it for you? Can you, as you said, apply and talk to the lender for a settlement? Does the settlement look good on your report?
Because you see, if you were to take it head on and you were to talk to the lender, the likelihood is that lender may not report this to the credit bureaus, and your credit is going to be protected. But when you involve the third party companies, their objective is that they will negotiate with them, and actually they will say, out of the $10,000, we will actually pay you $3,000, and they will charge their client $5,000, and they will make $2,000 from him or her, and they will actually settle the whole debt at $3,000. It's not a smart idea, and this is what actually I think we need to be educating our people, making them understand. Sometimes it's the fear which actually, imagine a situation that you had lost your job and you got 5 credit cards, you haven't actually paid them, and you are actually thinking, oh, if I pick up the call and actually talk to them, what will they actually be saying? It's the fear which is actually making you not do that. And that's why they do not want to confront that situation, and they want a third party to confront that.
I see. So even with the settlement situation, you as the person could call your own credit card company and negotiate a settlement, and that will be better off than going to a debt relief company. And a settlement, though it looks bad on your credit report, or what does it look like on a credit report, a settlement?
Settlement will actually look bad, but if you can, as I keep saying, it's actually if you confront it head on and actually say to your lender, we can't actually make this payment for the next 2 or 3, maybe 4 months. So likelihood is that they may not report this to the credit reference agencies, and your credit is not going to be affected, or your FICO is not going to be affected. Or they can actually just offer you, instead of actually, if your payment is $100, they may actually decide to actually only charge you $10 a month for next 6 months. So, but because you were actually making the payments to them on regular basis, they are not going to be reporting it to the credit reference agencies.
Right. And then in the same process, you won't lose your credit score for 7 years, because that's when If you
Absolutely.
do that, they'll definitely destroy your credit, and you hit collections, and you want to be able to go anywhere with that.
Absolutely. Agreed. Yeah.
Okay, very, very much. Ansar Saab, you've given very invaluable advice today and wisdom, to I think all our viewers today. We were able to enjoy a lot of your context. If we want to get further in touch with you, what's the best way to do so?
Like how Labid sir, like he gotten in touch with me, just like he ring me, email me, text me, and I will surely get back. And it's actually my objective is to actually help people. If God forbid, actually someone is actually in the situation that we are just described, just pick up the phone and I'll explain that. And if I can actually help them, and I'll just actually pick up the phone, actually talk to the lender, and on behalf of this person, it's nothing. Like he'll take me about maybe about an hour to actually get this done, and I will actually, I'll say, look, and they don't need to actually go to any third-party companies, pay extortionate amount of money, and so at least sometimes the advice is that you give it to people. It's so useful that they will benefit from that immensely. Like, going back to your mortgages, roughly, I'm just actually digressing on the mortgages. Sometimes people think that getting a low rate is phenomenal. I'm not saying it's not. It's good to actually have a very low rate also. But what people do not understand is that with some advice, they can save thousands and thousands on interest payments. On a quarter of 1% reduction on your interest rate will only save you about maybe maybe $10,000, depending on your mortgage over a term of 30 years. But given some advice, they could actually, if they were able to reduce the term of that mortgage, they will probably save hundreds of thousands of dollars. So it's sometimes this is actually just, it's like opening somebody's mind, just to actually opening to different, sometimes we have got a tunnel vision. We are not actually looking at right, left, and center. So, but it's actually just awakening their instincts, awakening their horizons, and
Right.
actually say, look, if you do this, you will save this.
Right. And now, going back to the mortgages, and your conversations about, of course, the interest rates in the banks, is it wise to open an account in a in a credit union versus a regular bank account? What are the advantages for opening your account and showing money circulation in a credit union versus just your regular checking account at a local bank?
It's the same whether you actually open in a credit union or into a bank, as long as it's actually being handled with care. Some credit unions will actually, because they are very small credit unions, they are more likely to lend you money based on your conduct of your account. So because they're actually, and they probably may well be, as a given an incentive of a loyal customer, they may actually give you a better rate with the credit unions. But if you're building your credit, doesn't make any difference whether you open an account into Republic Bank, Investor Bank, or Bank of America, or actually any credit union.
I see. So there's no actually added incentives. I see. And then after your pre-approval, and you settle on a house, let's say you want this house, do you put money down on a house too? I mean, or how does that work? Like I've heard from, if you visit a new home community, they ask for a down payment. What down payment is that? Is that the actual down payment that you owe for your mortgage, or is that the down payment for the house? And then the second part of the question is that when it comes time to the actual approval, do they just take the pre-approval and just sign off, or do they have to do something again to make it officially approved?
There are a few questions on this question. The first thing is that if you're buying a new build property, generally speaking, its house is going to be built in 6 months' time. So what they are going to be looking from you is actually some kind of token money to actually pay them as a deposit to actually put that house under contract. So that whatever those terms could be 1,000, could be 5,000, could be 10,000. So, but what they will do is that if the house is being built in October, so they will actually maybe about 30 days before the house is actually completely finished, they will actually tell you to now go to your lender that you actually got the pre-approval from, and to say that you are going to be closing on the house on this such date. So that's actually.
And the money that you put down for the house, is that the same money that's the down payment for the mortgage as well?
Yes, that will actually be part of the down payment. So we will, as a lender, we will actually be asking for to see whether that money has cleared the client's account and it's actually been in an escrow with the builder who's building the house.
Okay. And is it wise to go with the mortgage company that the builder wants you to go through? They make these advertisements that, oh, we'll pay closing costs for you and stuff like that. Is that a wise move or no?
One thing I've learned is actually there is never free lunch. Okay. It's as simple as that. There are two reasons why the builder will insist that you actually go with their lender. One is that if there was a problem with the mortgage, the builder will find out firsthand that there is a problem. So if they are not able to close on the property, they can sell the property immediately to someone else. That's one thing. Number two is that one of the reasons why they actually use their own lender is that because they can structure the deal or incentivize in a way that it's their lender and they can actually give you a lender credit or actually maybe enhancements to the house or maybe contribute something towards the closing costs. So these are the mainly two reasons why, but actually as far as generally speaking, rate wise, any lender will actually will only have a difference of 1/8 of a point, no more than that.
So when you're shopping for lenders, I mean, when you say lender and you say mortgage company, is there a difference between these two, a lender and a mortgage company? And how do you choose? How do you choose if you want to go to, let's say, your company, Allied Mortgage, or you want to go to Rocket Mortgage, you want to go to Fannie Mae, or how do you choose, or Blue Castle? How do you choose which company is good?
More and more people are using their own banks. So if you bank with Bank of America, your first inclination is that you go to Bank of America, go and see their loan officer, and they will actually then take the application and proceed with the application. In today's world, we are actually so techy, we technological driven. So you actually, when you put any news or any network, you will see Rocket Mortgages, this actually, or we are pre-approving you within minutes. So, some people are actually just going to go onto one of their websites and actually compare the rates and see whether you can actually. Then there are companies, there are sourcing systems which will compare all the mortgages, like Bankrate, I think is actually one of the providers that they will actually compare different, they will compare Bank of America, Chase, whatever, and see what the rates are. And so that's the plus actually sometimes in terms of whoever you go to when you're buying a property, you engage a real estate agent, they will actually then direct you to their preferable lender. Because again, the concept is the same, because why do you want to actually go to one of their lenders is because if there is a problem in the process of the application, they will be the first ones to know.
Okay. And so a lender and a mortgage company is the same?
Yeah.
Okay, I see. Now, there's a lot of discussion about, of course, getting a mortgage. Is it, for a Muslim, is it wise to get a regular mortgage, or versus should someone use Islamic banking? And there are people out there who come to different conferences and say, "Oh, you can, finance your next home using the Islamic banking method, and we won't charge you interest and this and that." What's the difference? Is it are we, committing haram if we get a mortgage and finance a home for that year and pay the amount with interest, or do we go to Islamic banking? What are your thoughts about that?
Safir Sahib, you're asking all these questions that I have spent so much time and invested so much time in this learning this. And I wish I could actually explain this to you in a more detail. But actually, Islamic mortgages to me are wolf in sheep's clothing. Purely how I do my Islamic mortgages in London, but actually the fact is it's a con. It's actually such a deceptive concept to have. What is Islamic mortgage? How Islamic mortgages are made of are actually they determine two factors. They determine a rate of return on that. Now, what is the rate of return? Rate of return is again it's an interest rate, because actually you go to a lender and they will say we are going to be extending that credit. We are going to be charging you this amount of money as a return on our money. So if you lent me $100, I will agree to you with you that I will pay you 5%, let's say. So that's a rate of return or an interest rate on that number. Second component
So
of that.
this rate of return is added to your monthly mortgage amount?
Yeah. This is actually, it will actually exactly work as a normal interest rate. But then they will also actually, second component to that is going to be the Islamic mortgages are going to be, they are instead of a principal, they will say, okay, this is actually the rate of return that we're going to charge you. And this is actually the rent we are going to charge you for living in that property. So it effectively comes to principal and interest. My very good friend of mine, Dr. Salam's son back in London, he's actually one of the guys who actually worked with the Arab banks, and they were the ones who actually came up with Islamic mortgages. So he actually had. So Islamic mortgage.
So on top of your normal mortgage rate, you pay a rate of return 5%, which is essentially a hidden interest rate per month, but they don't call it hidden interest rate. So how do these Muslim banks justify a rate of return? They call it a fee that you have to pay?
They're deceiving people, plain and simple. They're actually deceiving because unfortunately, some Muslims who actually opt out for this option, they do not understand what mortgages are. Effectively, they actually are deceiving them by way of saying, we are going to be charging you a rate of return, not an interest rate. So it's all in the wording, what they actually say.
I see. So and that rate of return is more or less incorporated into their mortgage amount, so they don't know that they're actually paying the interest.
No, they know.
Sorry, they know they're paying a rate of return.
They know that actually they're paying a return, but actually they're going to actually say how the contract is structured is that they're going to say if you're buying a property for 100,000. They will say, we will actually, for you to live in that property, we'll charge you a rent of 1,000. Okay? But because we've actually lent you 100,000, we will now charge you a 5% return on that money that we have extended to you. Sorry, excuse me. So that will actually be two components of that. One is the rental and one is the rate of interest. And you can actually just pay that amount at any time. It actually does not make any difference like any other mortgage in the US, any conventional mortgage, that if you took out a 100,000 mortgage, you are not penalized for making that payment early. You could actually just cut them a check 2 years after you've actually taken out the mortgage and actually pay the whole amount. It's only in London. There is actually two things that they actually do is that actually in England, they actually have got two contracts. One contract is that the bank still owns the property. Still owns the property, you are a part of that, and actually once you've actually paid the whole amount back to the bank. The deed is transferred in your name. But what Muslims do not understand is that if effectively, if it was a mortgage, Islamic mortgage, if the value of the property was to actually come down, would actually bank will be prepared to take that loss also? They wouldn't. You go to any Islamic bank or anyone who's actually extending the Islamic mortgages, you say to them, you simply pose them this question. Okay, fine, you're lending me 100,000. What happens if the value of the property was to come down to 50,000? Would you then start charging me interest on 50,000, or rate of interest, rate of return of 50,000 or 100,000? Always, the answer is going to be that we are going to be charging you a return on 100,000, not on 50,000.
I see. And then in an Islamic mortgage, it's the same things you go through. You go through a mortgage insurance, you
Absolutely.
go through a homeowners, you go through a down payment. Everything's the same.
Yeah.
But there's no really any. They may put it in the facade that there's no interest rate, but in fact there is, because they have to make their money somehow. Yeah. So getting a regular mortgage is not a haram thing to do. It is something that we can do, right?
No, it's just actually not haram at all. Even if you look at actually the sermons of, if you study sermons of Khalifa Masih Rabi Rahimahullah Ta'ala, and actually only recently also in one of the housing complex webinar that we had with Amir Saab, a question came up also whether actually you can actually buy a second home, whether it's actually not allowed to get a second home on a mortgage, whether it's permissible or not. So Amir Saab answered that, and he said, yes, as far as we are concerned, they can actually just get a second mortgage, second loan, or second, third, or fourth, whatever. But it's, you see, what I'm trying to get to is that how best you can minimize the payment of the interest. On a 30-year conventional mortgage, which is conventional FHA, whatever you want to call, you will actually on a 30-year, you will probably on 100,000, you will probably pay about 50,000 interest. But if you can minimize that interest by actually reducing the term to 15 years, you will probably only pay about 20,000 interest.
I see. And then the only way you can reduce that is after you refinance. So refinancing is a good option to do. When should you and when should you not refinance?
I have come across people who I have actually called me for refinance, and I've actually said it's not in your best interest to refinance, because it all depends how much, what is the rate that you have, and how much is the mortgage outstanding. I had a call from North Carolina about last year. The lady had 100,000 mortgage, and they were actually interestingly with Rocket Mortgages. Okay, and they were actually paying. I could have actually reduced the rate. That was not a question. But even by reducing it, it was not in their best interest, because by the time they actually paid the closing cost and whatnot, it would not have actually made any business sense for them to do it.
So, I see. So when you refinance, you have to do everything all over again: the down payment, the closing costs, everything at that time, right?
It's not like It's sorry to cut you. It's not the down payment, because you already have an equity in the property. So,
I see.
So it's not that, but it's like you have to also look at the other closing cost also. And by actually doing the lady that she rang me, I actually recommended her that if you're paying on top of your $500, if you start making extra payment of 200, so you will actually cut the term also. So it all depends. It's actually,
I see. So you could technically cut the term on a 30-year mortgage by paying extra instead of refinancing, and it won't make a big difference between the interest rates either over time, right?
Over time, yes, but it all depends on what interest rate you have. Let's say if this lady had actually come to me, she was paying 4%, and her loan was, let's say, 300,000. Then there was a business case for me to actually reduce the rate and then actually refinance it. But in this case, when I equated all the closing costs and everything, it was not making any business sense. So I said no to her, and she was very thankful, and I suggested that you start making higher payments, which he did.
Okay, well, interesting. Now let's say if you're interested in getting a property for investment only, can you get a FHA loan or a conventional loan on that? Can you use the 3.5% or the 5% on a conventional loan? What are your recommendations? If your sole prerogative is to get a property just to put it on rent, can you rent a FHA property?
You can rent an FHA property as long as you have lived in that property for 1 year.
Okay, so you physically would have to move there, change your address, live in that property for one whole year before you can rent it out.
Yes, but if you're talking about as a buying a property for investment purposes, then generally speaking, on a single family house, you have to put down a minimum of 15% down, and then of 20 or 30, up to about 25% if it's actually a multifamily.
I see. Multifamily 25, single family 15.
Yeah.
And for a condo, it's the same thing, 15% too, right?
Yes, you can
I
get
see.
away
Okay.
with the 15 to, depending on the condo fees, and depending what the condo associations are, but actually 15 to 20%, yes.
So you could rent out your entire property on an FHA loan after you live in for the year, both for FHA and for conventional, correct?
Yes, but again, it's actually even for conventional also, if you're putting down 3.5% to 5%, you have to live in that property for 1 year before you can actually start renting it out.
I see. Okay. I see. And is it wise to rent out these properties that you have on your own mortgage, or not wise?
It's a good idea in a way, because it all depends on your personal circumstances. One, that you have bought this property with a 3.5% down. So imagine if you were actually buying another property for investment purposes, you could actually have to put down 25% down. But in this case, you actually only put down 3.5%. On an investment property, the rates are slightly higher, but in this case, you actually had a lower rate anyway. So it's actually, if you can, then it's actually always a good idea to do that. But not
I see.
always, but if you are actually in that situation.
I see. And then for FHA loan, now let's say if you put the money down and everything, but you decide to still rent it out, all right? Because if you say within 60 days you would have to move into the home. Let's say you don't move into the home and you rent it out. Will anybody find out, or
Yeah.
do anybody come and check? For which loan did you have that you're not actually living there?
No one will physically come and check whether you're living in that property or not. But okay, effectively, you are committing a mortgage fraud, because you are telling the lender that you are going to be moving into that property as a primary residence, and then you decide that within 60 days, you're right to actually that you are going to be able to be moving into the property, but then you decide that you have rented the property. No one will find out, but again, it's actually it's not legal, and you're not allowed to do it. But
Right. I'm for, and for FHA and conventional both, you're not allowed to do unless unless your mortgage is an investment mortgage where you put 15% down, then you can immediately rent out that property.
yeah, because you're telling the lender that you actually are the whole sole purpose of buying the property is to rent the property out.
I
But in
see.
this case, you are misleading the lender and saying, we are going to be living in that property as a primary residence, but then you end up actually renting the property. No one, as such, no one will come knocking on your door, but it's more effectively misleading the lender.
Right. And mortgage fraud, the consequences of that means what? That they will accelerate the mortgage and ask you to pay everything up front, or
It's a mortgage fraud is actually going to be FBI will actually be involved with the mortgage fraud, because actually a lot of people, it's a very serious crime to have actually to commit mortgage fraud.
I see. So the FBI gets involved, and then you lose the property, and then a lot of serious legal consequences
Yeah,
afterwards,
you
right?
will be taken to courts and all that. So this is actually so.
I see. So yeah, it's not wise to do. Now, if
No.
let's say you're living in the property
Hmm.
and you want to rent out a room, but you're living there, is that allowed within
Yeah,
the time period. Okay. Okay. It's just the
Absolutely.
whole premise. And after, let's say after 1 year, you're living in a property where you had an FHA loan or a conventional loan, and you want to get a second home mortgage where you want to move into a new home, and you want to rent on your first one. That's fine too, right? After 1 year.
Again, as you see, as long as you are telling the lender that what your intent is, what you are trying to achieve, that's good. Coming back to Aki, your the other question, if you are Aki buying a 2-unit property also, so you can live in one unit and the other unit you can rent it out. That's absolutely fine too.
Well, that's fine too, exactly. Right. And so for a multi-family house, you could do a 3.5% on FHA loan, live in one unit and the other unit rent out at the same
Yeah.
time simultaneously, and that's fine.
Yeah. Yes.
Oh, okay. Interesting. Okay, very good. I think, Answer Sab, I think I have covered all the points I wanted to discuss today. Jazakallah for joining us on this session. I hope the viewers, if they have any more questions, they can definitely reach out to you. We will provide your contact information for that. We've talked about a whole variety of topics: real estate and mortgage and investment and managing debt. So in the end, in conclusion, going back to this credit system that's in America, you talked about in the beginning, the what makes up a credit score, right? And you talked about the different percentages. 35% was on-time payments, right? 30% was your credit utilization. And what was the remaining percentage, the 40%?
Yeah, I just actually I preempted your question, so I've just actually opened my slide here. 30% is the amount that you are owed, so you're making regular payments. So 30%, sorry, utilization. Beg your pardon. Sorry.
So how much you're actually using your credit cards?
Yeah, and
Okay.
35% is the payment history. 10% is a credit mix. Now, what I mean by credit mix is that if someone has got 3 credit cards, okay, his credit card is actually, and he's making the payments on time and utilization is good, his credit score is going to be good, but it's not going to be excellent because he's not using the mix. And when I say mix, he needs to have a credit card, an auto loan, and a mortgage. So that actually makes 10% of that. Then we've actually got 15% can be attributed to the length of the credit, So if you have got a credit card which you actually have had for 2 years, and or an auto loan for 2 years, and it's a longer, the duration of that is actually is the length of the credit history, which also determines, which is 15%. The last one, which is actually new credit, is 10%. So when you open new credit, that will also enhance your FICO as well. Just to actually put something into this also, people have got this habit, and we must refrain from this thing. In today's world, we actually get these pre-approved approval letters. Probably you get it, I get it every day to actually say,
are we actually pre-approved at that point or no?
They have actually collected this information based on our credit that we have utilized so far. So they are actually on basis, and they've actually got their credit score also. So they actually saying they haven't actually got our incomes or anything, nothing like that. So they have actually got our credit score, and so they will actually send you a letter. So strictly speaking, you are not pre-approved. You still have to apply, and actually the lender has got the right to refuse extending credit to you. But the more credit applications that we make, the more footprint that we have of the credit, it's bad for us. Normally everyone actually has about maybe two credit cards. You use them, you spend it, but actually a lot of people have got this. I see this every day. The other day I had someone come through and he had 40 credit searches, and I asked him why, and he said, well, I had this letter come through. I thought, okay, why not apply for it? But every time that you apply, your credit comes down also.
So how many points do you lose when you apply for credit?
Maybe about 2 or 3 or maybe 4 points
I
that
see.
you
I
lose.
see. I see.
But again, I can
But
imagine a bank.
it's very easy for your credit score to drop, but very hard to gain.
In a way, yes. But again, it's actually if you actually, it all depends how many inquiries have actually been made. So look, every inquiry stays on your file for a minimum of 2 years. Okay?
How many inquiries should you have in 1 year?
Maybe actually generally speaking, 4 or 5 inquiries are good because actually because you have to remember your own credit card company also actually doing inquiries on you when every time they want to increase your credit limit, they will actually be doing it. Okay.
So I mean, when you go for an auto loan and they send your credit out to different banks, four or five banks, is that a wise thing that they're doing? I mean, you would have 5 inquiries on one day.
No, as long as the same institution has carried out, that is not going to affect your credit. So if you went to a auto loan company and you wanted to buy a car, and they actually ran different, they've got 5 lenders. So you are shopping for a rate. So that's actually only going to be considered as one inquiry.
As a one pool, basically.
Yeah.
Okay, so pooling means where they have to pull your credit. And what's the difference between a hard pull and a soft pull?
Soft pull normally is done by your own credit card company, that they will actually just be determining whenever every few months they want to actually increase your limit. Okay?
I see,
So
and
they
has no effect to your credit score.
no, that not. And hard pull is that when you physically go and apply for a credit for this. And a soft pull also will be by your the pre-approval letter that you actually get. That will be they will be doing a soft pull also, but it's not going to show on your credit.
Okay, I see. So just to recap for all the viewers that are today, if you can just go over one more time, building credit, okay, what must happen in terms of the percentages that you must do?
If you are new to the country and you want to build your credit, there are 2 things you can do. One is you can actually go out and actually get a cash card. Effectively, what cash card means is that you go to your bank, you open a bank account, and actually you give them $500 and say, okay, fine, this is the $500 you keep in the bank account, and actually you give me a credit card. So with time, gradually you spend that money and you return the money on time, you actually start building your credit. Or you go to a friend or relative and actually ask them to actually become a co-signer on your credit card. And so you will actually then, although they have co-signed it, but you are actually going to be building your own credit. Okay?
I see. So when you become an authorized signer, you build your credit.
Yeah, you will actually, as if I was actually, let's say that if I was new to the country and I wanted a credit card, I came to you and say, Dr. Saab, can you just actually sign me as a co-signer because I actually have got no credit. So once you actually co-sign me, I got a credit card and actually I spend and actually paying that on time.
I see. Okay. So okay, so you get a cash card, right, or authorized signer, and then once you do that, then you can also build your credit. So that's the first step. And then if you can just go over the percentages one more time, so everyone can understand, what makes up the 100% in terms of your credit score.
30% is made up of amounts owed. When I say amounts owed, that you have how best you have conducted your financial affairs, whether you've actually been able to pay your payments, contractual obligations on time. 35%, beg your pardon, I'm wrong, sorry. 35% is the payment history that you actually made the payments on time. 30% is the credit utilization. 10% is a new credit, credit mix. 15% is the length of credit history. 10% is new credit.
Okay. Excellent. Okay, that's very good. So some key things to keep in mind. As you know, of course, when you're coming into the country the first time, or building credit, or you're in the process of building credit, these are some things to keep in mind while you're making these payments. Okay, Jazakumullah for your time. I understand this session went a little bit overdue, but I think it was a very insightful learning. I wish we can do this again sometime soon. Jazakallah for everything. My name is Safir Bhatti, and I have Atiq Saab, my co-host today. Jazakumullah, and have a good night.
Jazakallah. Thank you very much.